Why are money managers selling riskier equities and moving into safer ones? After a very nice move higher year to date, why are investors moving money from riskier tech and innovation stocks and into safer Dow and consumer staple stocks? The common wisdom says you should rebalance your portfolio after big gains. And that's my thesis for what happened this past week. From everything I can see, and I'll show you what I'm seeing, investors and institutions are selling their riskier tech stocks and moving into the safer Dow stocks. After all, as the keeper of your money or your client's money, you have to do something, right? You can't just sit and watch your investments go up, or can you? Common wisdom isn't always wise. Over-rebalancing will ultimately limit your returns and not provide much, if any, protection against downside losses. If you want proof, just watch my video, Why Most Money Managers and Retail Investors Will Never Beat the S&P 500. Link in the pinned comments below. And by the way, this type of big upswing is very normal after a major move downward. But just how big is this current upswing? And should you be worried? Here's what I think. Right now, I think this rotation out of risk and into safer equities is just the fools being foolish. And let me show you why I say that. Just look at the upward moves here in the markets after bottoming in 2003, 2009, 2020, and 2023. So what are you looking at right here? Well, what I did is I graphed the performance, the growth of the S&P 500 from the market bottoms in 2003, 2009, 2020, and 2023. And what you're looking at here is the number of trading days after the market bottom. So you can see, for example, in 2003, after the market bottomed, it went up 45% in just about a year. 250 trading days is roughly a year, elapsed time. And you can see in 2009, the S&P was up 72% a year after the bottom. In 2020, it was up almost 80% a year after the bottom. And now in 2023, we're only up 21% since the bottom. I think we've got a ways to go here, don't you? And what are these numbers up here that I've listed? Well, if we look at the dot-com bubble crash, that down market lasted 741 trading days. That's almost 3 years of a bear market. And what was the maximum drawdown from peak to valley? Well, in that case, it was minus 45.62%. That's a pretty big loss. Now, in the financial crisis of 2009, that one lasted about 355 days, so roughly a year and a half or so, and it had a minus 55% maximum loss or drawdown. What about during the COVID crisis in 2020? Well, that was very quick. That was a 23-day drop from peak to bottom, and it had a minus 33, almost minus 34% drawdown. What about more recently in 2023? Well, that one lasted 196 days, so not even a year, really, in terms of trading days, and the loss wasn't nearly as bad, 24.5% drawdown. Now, why did this one feel so much worse? Well, it felt so much worse because there was nowhere to hide. The only two sectors that went up during that drop in the markets were energy and defense, aerospace. Gold, I think, ended up a little bit flat. So there was really nowhere to hide here. Bonds were down, equities were down across almost all sectors. It was just ugly, plain ugly. And what if we look at the NASDAQ 100? Well, let's take a look at the NASDAQ 100 over those same areas. Now, I'm not going to list the days for the bear market and how much they dropped and all that. You kind of got that sense from the S&P chart earlier. But if we look at 2003, the dot-com bubble, the NASDAQ recovered, if I can read this correctly here, 70% 1 year after the bottom? And what about 2009, up 72%? What about 2020, up almost 90%? And then more recently, in 2023, you can see we're up only 45%. I have to laugh when I say only, that's a pretty big gain, but you can see we're well short of these types of gains so far. Now look, that doesn't mean we're going to get there, a year after the bottom, but I think it's pretty early innings here. I don't think we're even in the fourth inning of the ball game here in terms of this recovery. So given that backdrop, let's take a look at the overall health of the equity, bond, gold, and crypto markets to see if there's anything to worry about. As you can see here, if we look back over the past week, this is exactly what I was saying happened. So ARK Invest and the NASDAQ 100 ended up the week down, while the Dow ended up the week up, the most actually. So this is clearly a flight from riskier equities to safer equities. And what if we look back over the past month? Well, if you look back over the past month, ARK is still leading the way, so this is fairly healthy. But the NASDAQ has really started to falter here, and it's below the Dow Jones Industrial Average Index here in yellow. Actually, they're almost tied. Small caps are in second place here. And what about year to date? Well, if we look at year to date, this is a very healthy stock market rally. ARK Invest up the most, NASDAQ second, S&P third, small caps fourth, finally the Dow in last. This is exactly what you want to see coming out of a bottom. And what are we seeing in the current bottom dynamics? Well, if we look at the bottom dynamics, there's really not a whole lot to see here. You can see that the S&P 500 has been going higher. The bottom confirmation indicator has been going higher, but the confidence has been falling. That's a little concerning. You really want confidence to be rising as the market rises. And the other thing that gives me a little bit of pause here going into next week is that the safety confidence is also rising here. So, this doesn't really look that good in the short term. But if we look at risk versus opportunity, this looks great. I mean, you've got risk, which is this red line, declining here. It's below 60. I don't really get concerned with this one until it gets up here above 80. It's nowhere close to that. Risk acceleration is also declining. It's down here around 50. I don't get concerned with this until it's well above 60. And you can see equity opportunity, this blue line, is sort of trending a little bit higher here as the market goes up. So this looks really, really good. And what about equity versus safety? Well, if you've been watching my previous videos, you'll know that the NASDAQ 100 has been in first place for many, many weeks, probably more than double this number of weeks. But look what's happened recently, and this is what I'm talking about today. This is my thesis. Investors and money managers are selling the NASDAQ 100, selling the tech stocks, and moving into the safer stocks. And you can see that the Dow has moved from fifth place up to second place. But if we ignore that, how does the rest of this picture look? Well, I always follow the cash, right? Follow the money, as they say. And you can see cash moved up here, which gave me some concern. But then it moved down here to sixth place, and it stayed there. So this looks great. This looks very healthy. That's why I think this is really just a rotation. Investors are saying, oh my God, my tech stocks have gone up a huge amount. I better take some profits and lock them in. I think that's not going to age well, but we'll see. So what else do we have here? Well, we finally have the Treasury market in a very healthy state here. The riskier Treasuries, EDV, are above the shorter duration Treasuries, and the long bond TLT is still down here. But I'm guessing if this rally continues, it will eventually move up here. But this is starting to look very, very healthy. And I like the fact that equities are up here in 1, 2, 3, and 5. Gold is still holding up here in fourth place, so it's kind of displaced the Qs. But we'll see. This looks very good to me so far. And how does this show up in the buying and selling pressure? Well, remember I said my thesis is that Investors are selling the NASDAQ, which you can see here, selling pressure going up while the price is dropping, and putting their money in the safer Dow stocks, buying pressure way above the selling pressure, and you can see the price has really launched higher here. This is a rotation. This is profit taking and shifting your money from riskier assets to safer assets. S&P 500 looks better than the NASDAQ. It's considered safer than the NASDAQ. In ARK, you can see its price is falling. You can see that the buying pressure is falling and the selling pressure is going up, just like the NASDAQ. So you can see the contrast here between the Dow and the S&P, where the buying pressure is well above the selling pressure, and the NASDAQ 100 and ARK, where the selling pressure is shooting up. What about small caps? Similar picture, dropping prices, selling pressure shooting higher. Now let's take a look at the sector rankings, because this really gives you a good picture of what's happening in the markets right now. Now these are a longer view, but what you're looking at here is the top table shows us the sector rankings for last week. And you can see last week we had Bitcoin in first place, technology, semiconductors, consumer discretionary, ARK innovation, Yahoo. This is a really healthy looking stock market. You can see consumer staples and cash were down here. This is good. And you can see that the Treasury market looked fairly unhealthy. You've got 20-year Treasuries here, shorter duration intermediate Treasuries here. So unhealthy Treasury market, but very healthy risk appetite. Well, let's fast forward to this week. This week you have the same picture here. In fact, I almost have to look twice here because these are almost identical up here at the top. Bitcoin, technology, consumer discretionary, ARK innovation here. You can see that cash has moved down, so this is even more healthy looking, and Treasuries still show the same kind of relationship here. So this is a very healthy risk appetite. So now, if we take a look at sector rank acceleration, remember this is telling you kind of where things are heading. These move very quickly. You can see in this top table, which is last week, that gold was way up here in the number 2 spot, ARK innovation in the first spot, consumer discretionary down here. Now we had technology kind of in the middle of the pack, consumer staples here, and cash way down here, which I love, and Treasuries were in sort of an unhealthy relationship here with longer duration down here. Now let's go to this week, and this week you can see that we've got innovation still number 1. Interesting that consumer staples has moved from down here to up here. This is that rotation out of risk and into safer stocks that I keep talking about. And then you've got consumer discretionary has moved down a little bit. Cash has moved even lower. This is great. This says there's still a healthy risk appetite. And then you can see that Treasuries, the long duration Treasuries, have totally flipped here. So we've got these ahead of intermediate to long Treasuries and intermediate Treasuries. So this is a healthy Treasury market, at least in the short term, and a fairly healthy looking equity market. This is great. And how does that show up in the 1 week performance? Well, you can see that over the last 5 days, the riskiest Treasuries, this purple line, EDV, are up the most, followed by the long bond TLT, and then all of the shorter duration Treasuries actually finished the week slightly negative. So this is starting to look like a healthy Treasury rally. What about over the last month? Well, if we look back over the last month, you can see this is unhealthy. The longest duration Treasuries at the bottom, TLT next, and then followed by the shorter duration Treasuries here. So unhealthy looking over the last month, healthy looking over the last week. What about year to date? Well, if we look year to date, again, we're still not far off this very low bottom here. So things are recovering, but I think these still represent a fairly good opportunity going forward because they're fairly safe and they're down near their multi-year lows. So we'll see what happens with these. And how does all of this show up in the buying and selling pressure? Well, if we take a look here, You can see we've had a jagged rally here in the short duration treasuries. These are 1 to 3 years. You can see that the buying pressure was above the selling pressure, and now they've swapped places here. Intermediate treasuries, you can see that there's a lot of selling here. Selling pressure shooting up very quickly, prices dropping. You can see in the 7 to 10 year treasuries, price action kind of down, slightly down, selling pressure shooting up. And then in the longer duration treasuries, while we've had a nice rally, you can see that the selling pressure is starting to increase here. So in the short term, it looks like treasuries may go back down again, but there's no way to really tell. And what about the inverted yield curve? I don't like what investing.com did with this display. They made this smaller. They took away the Fed rate monitor that used to be right here. So I'm not a fan of what they did, but we'll work with it. So you can see, as I keep talking about, the yield curve was inverted 1.1% here. In fact, you can see it right here. It was down 1.11%, 111 basis points back here in March. It tried to recover, collapsed again, started to recover and collapsed again. This is really stuck in a bad place. And hopefully the Fed will finally start to recognize that inflation is moderating through the lagging indicators that they follow and stop raising interest rates. And hopefully that will cause this curve to stop in being inverted, or at least move toward being uninverted. And with the Fed meeting this coming week in 3 days, 4 hours, and 42 minutes, you can see that the markets are voting a 99.2% chance that the Fed will raise interest rates another 0.25%, or 25 basis points. So this is pretty much baked in, and it will happen. The question is what happens after that, and who knows? And what about gold? Yep. Well, gold really had a strong rally here, and you can see that recently the price is collapsing. Now, the buying pressure is still above the selling pressure. So will this turn around and go higher, or will it continue lower? Tune in next week to find out. And what about cryptos? Well, you can see we had a huge spike in buying pressure back here, off the charts, and the price just shot up. And this was around the announcement that BlackRock and Fidelity were trying to get Bitcoin ETFs approved. So the markets really jumped in here and saw this as a positive sign. Now, since that time, you can see the performance has flat topped and in fact is on a slight downward trend. And you see that here with the selling pressure starting to shoot up. So until this all resolves and there's some real direction going forward, both from ETFs getting approved or not approved, and from the regulators approving or disapproving of cryptocurrencies, this isn't going to do much. As I've just shown you, this past week there was profit taking in the riskier equities like the NASDAQ 100 and the ARK Innovation Fund. The metrics continue to look extremely healthy. So I don't think this move by investors and institutions who followed the common wisdom and sold their profits will age well. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
This life feels like the sunny water. Wet my lips, but the sun is running. Pour it out, if I'm being honest. It's just not everything you promised. Running out, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold but it's lonely, yeah. This life feels like the sunny water.